Talk with Real Estate Pros, where we bring you exclusive interviews with the real estate experts. We'll delve deep into their journey to success and learn how to go the extra mile to serve their clients' wants and needs. Let's dive in. Here's your host, John Money McKinley.
Morning, everyone. Welcome to another edition of Real Talk with Real Estate Pros. Got another great show for you all here this week, and we got Christmas right around the corner, so I figured I'd have the nice little Christmas bumper music intro. But I want to thank everybody for being here today. We've got a lot of great things we want to talk about today. I'm sure a lot of you have heard that there's been some wonderful changes that happened from the Fed just the other day with the lowering of the interest rates again. And we want to dive into that because there is a lot of misunderstanding on what happens when the Fed does lower the interest rate and how that affects things. I would like to ask you all, though, to please do me a favor. We're really trying to build a community here where I can bring you all some great experts in the world of real estate, finances, credit, and a little bit of everything that has to do with the world of real estate. Because at the end of the day, we are all in the world of real estate. Whether you live in a home or even if you live in an apartment, real estate is definitely a part of your lives. And I want to have a place where people can come to and be able to get the truth about what's really happening in the world of finance when it comes to mortgages, as well as what's happening in the credit markets. And everybody that I bring on my show is an expert in their field, whether it's folks from real estate, whether it's my guest that I have today. He's an expert in the world of credit, as well as myself. I'm a professional in the world of mortgages. And would like to ask you all, if you would, please do me a favor, like and subscribe and tell your friends about the show. And we're really looking to go to the next level next year and get a lot of more great guests on in 2025, because there's going to be a lot of changes that are happening. And I want to make sure that we're here to be able to deliver that information directly to you all from professionals who understand what's happening. But with that said, I would like to bring on my guest, longtime guest, Mr. Greg West, credit expert extraordinaire. How are you doing this morning, Greg?
Pretty well, bud. How are you?
I'm doing good. Are you ready for the holiday season, sir?
Oh, yeah. Wife prepares that months in advance.
That's a good thing. You got eggnog and all the other Christmas festivities ready to go?
Not the eggnog, but I got all the baked goods and the gifts and the decorations and all that jazz.
Awesome. Well, I have my Christmas tie. You know, I have to stay within the spirit, the charming Grinch. So wanted to make sure I was in the festive spirit, considering we're going to be digging deeply into what's happening with the Fed rate cut. But I would like to, though, let you just kind of give people a quick synopsis of who you are and who you're with and where you're at on your level of expertise, Greg.
All right. Well, as far as who I'm with, it's with myself, I guess. I'm self-employed, been doing in the credit industry for almost 25 years, as far as helping people get their scores up, fix up their credit reports, or as they call credit repair, whichever. But basically get them in the best possible position for lending. And if I can't help them, I'll send them in the direction of somebody who can. So that's pretty much what I do. I do dabble into and had to be taught about what we're going to be talking about today, because it's very important. And I like to say that I am not a financial advisor. I'm not your dad. I'm not going to be telling you what to do or how to do it. We're just going to give some facts and then use your discernment and intuition of what works best for you, what you think you should be doing as far as interest rates, stocks, bonds, things like that.
Exactly. And I appreciate you mentioning that, Greg, because at the end of the day, everybody has to make the decision for themselves on what they're going to do. I just want to bring as much as much information to the table so my listeners and viewers can make an informed decision on what they should do in their life choices. Because housing, once again, is one of the most expensive part of people's lives.
Yeah.
I mean, I'm right here in the Houston area, North Houston area, and just on rentals, average rents are $1,800 to $2,300 if you want to rent, and that's just for renting. I mean, you're in Kentucky, so what is it, about $250 a month for renting there, Greg?
Yeah. For the nicer places, depending if it's 1 to like 3 bedrooms, 12 to 1,500.
Okay. Which,
at least in my area. Now Lexington and Louisville is probably higher, but yeah.
Even just 4 years ago, rent wasn't anywhere near that level.
No.
And that's something that I'm seeing a big surprise that's happening to a lot of my clients that I'm working with when it comes to the financing side of things, as they start looking at the monthly payments with what we've seen happen with insurance and what we've seen happen with the interest rates. And people are like, oh my gosh. And the best way to really explain to everybody to get an idea of what your monthly mortgage payment will be if you're going to go in with a low down payment is take the purchase price and multiply it by 1%. That will give you a higher estimate, but it'll give you a good idea, at least here in the Houston area, of what your monthly principal, interest, taxes, and insurance will look like. So if you're looking at putting, let's say, a 3.5% down payment on a $300,000 home, roughly you can plug in the $3,000 number. Now, that's going to be on your higher side, but I would rather have people, when they're out looking for homes, especially in the beginning stages, look at the worst case scenario first. That way, when they come across something and find out, oh, wait a minute, I've got good credit, or I've got a little bit more money for a down payment, and we can get their payments down to $2,600 a month, they're in a lot better position than going in thinking, oh, I'm going to get a $300,000 home for $1,800, which unfortunately, those days are long gone, sir.
They are, yeah.
Well, with that said, speaking of interest rates, let's dive into what we were talking about. I'm sure a lot of you all have heard the Fed did cut the rates just the other day by 25 basis points. And I know a lot of folks were going, oh, wait, the mortgage rates are coming down. And unfortunately, that didn't happen, nor does it usually ever happen. And we can see here what the Fed said was the Fed expects to cut rates more slowly in 2025. What would that mean for mortgage debt and more? The New York AP, Associated Press, trusted and assured Associated Press, the Federal Reserve, the Federal Reserve's third interest rate cut of the year will likely have consequences for debt, savings, auto loans, mortgage loans, and other forms of borrowing by consumers and businesses. But with inflation pressure still elevated, and with concern that President-elect Donald Trump's policies could fuel inflation, the Fed indicated Wednesday that it's likely to cut rates more gradually in 2025 than it had projected 3 months ago. And that's something that I'd like to get into a little bit here with folks and kind of break down what they're saying here is when the Fed reduces the Fed reserve rate, that's for the short-term rates. That's on the overnight money that is back and forth between banks. That's going to have more an effect on your short-term loans, such as your credit card interest rates, which that's a good thing if you have a high credit card debt because you may see a little relief from these further rate reductions. The challenge that we're having, though, is this doesn't really have an effect on the long-term rates, and we're going to get more into that later. But if Trump is going to come in and really get this economy running again and get it heated up and make it a very friendly environment for businesses, it's going to have an ill effect on the interest rates. and for the long term, for the mortgage rates.
Yeah.
When the economy is doing well, money is not going into the bond market. And we will get into the bond market and explain what's happening with that. Typically, your money is going into more risky investments or going into the stock market, moving away from the bond market. Well, when money moves out of the bond market because the economy's doing great, that leads to higher long-term interest rates. What are your thoughts on that, Greg? Do you have anything you'd like to add with that?
Well, as we get into the show here, we'll try to simplify this because it can be confusing. And it also depends if it's a good or bad situation, depending on your own personal situation, whether you're a rich guy with a huge stock portfolio, or if you're disabled or with fixed income, whether it can be inflation, deflation. There's a lot of factors. So not every situation is bad for everybody, and vice versa with good. So we'll kind of try to simplify it the best we can, because if you watch the news, if you watch different things and they explain yield curves and rates, they do it, in my opinion, do it on purpose, and people just believe what they hear because they don't understand really how it all works. And we're going to try to hopefully help you guys with that today as we go through these charts.
Yeah. And that's another thing too I'd like to stress to folks is to have yourself in the best position possible. You always want to keep your debt as low as possible.
Yeah.
Unfortunately, housing debt is the debt that most people have to have because it'd be very difficult to save up the amount of money for most people to be able to buy a home, which is okay because you do get some tax benefits from home ownership. You also too get the joy of the appreciation when you have the home ownership as well. But you really want to set yourself up in a position to where you can be eliminating other debt, to have yourself in a position where if something goes wrong in your life or something goes wacky in the economy, like we go into a recession, you don't have a lot of monthly debt. And that's where I think a lot of people get themselves hurt, especially in this economy or any economy, is there's so much opportunity today where people can get, oh, you can't afford it now, you can buy it on payments. And that's something that we're having to look at when I'm dealing with people to get a home loan. There's a lot of these lending companies out there that will give you financing on things for 6 months, 12 months, 24 months, 48 months that doesn't go on your credit report and really doesn't reflect on your credit side. Because what they do is they have you do what's called an auto debit from your checking account.
Yeah.
And that's something that when I'm helping people with loans, we are looking through the deductions that come out of your checking account and go, oh, wait a minute, here's a payment, a monthly payment over and over and over again. We have to then document what that is, find out what's going on with it, and then we have to deduct that from your monthly income. And in some cases, that can cause a hiccup in the lending side, because if we're running in and running our numbers and we didn't know about, let's say, a $300 debt, and then we get the bank statements and that comes up, that can derail a lot of things for a lot of people.
Yeah. If you're buying something that's a few $100 and you got to put on monthly payments, you probably need to think, should I be buying this at this point?
Exactly. And that's why I stress to folks, if you're thinking about buying a home, you want to sit down with a mortgage professional. Hopefully, John McKinley is your mortgage professional, and sit down face to face with that professional and really get an understanding of where you're at, what's going on, and where your true finances are. Because the last thing you want to have happen is go out, find the home that you and your family really like and fall in love with, and then start getting over all the documents and everything to your mortgage professional, and then find out you have a problem.
Yep. Definitely want to have figure it out beforehand.
Exactly, because you don't want to have to look at your family after you found the home that everybody seems to like, and the kids are starting to pick out which bedroom they're going to get, and you go, well, kids, there was a problem. What do you mean there was a problem?
Yep.
And, well, let's dig back into these mortgage rates and see what's going on. I have another article here from MSN. Let me blow this up just a tad here so folks can see this a little better. And at the start of 2024, the path to lower mortgage rates seemed relatively clear-cut. Officially, inflation would go down and the Federal Reserve would carry out more interest rates cuts, and the cost of borrowing would gradually ease in 2025, which there's some half-truths in that, and that's what I hate when the media especially combines the Fed lowering rates with thinking that your mortgage rates are going to lower, which is just, that's not the case, and that's not how it works.
Yep.
Now, the housing market experts aren't so certain anymore. Mortgage rates are not going to come down as much as we expected, and affordability will still be a challenge, said Lisa Stroutvant, chief economist at the real estate agency Bright MLS. Elevated mortgage rates aren't the only reason why homeownership has become largely inaccessible. As mortgage rates soared in 2022, home prices hit record highs and inventory shortages persisted. Though mortgage rates have fallen from 2023 peaks, not necessarily true. Rates have been on a big upward trend, especially since the Fed spoke in the middle of this week. The decline has been slow and gradual over the past 12 months. Then it gets in, and the rates fluctuate between 6.5% and 7.5%. Most housing economists had expected mortgage rates to drop to 6% by the end of 2024. This is true. And Greg, you and I have been doing my show for a while and talked about this. And I've been leaning more on the side that we could see this taking longer than we had expected on the rates to drop. I know, especially at the beginning of 2024, some of the experts that my industry listens to were all rates are dropping, rates are dropping, rates are dropping. And depending on who wins the election, we could really see the rates fall off the cliff. And as we know, that did not happen at all.
No.
And now it says here, many economists say President-elect Trump's proposed policies, which include tax cuts and sweeping tariffs, could stimulate demand, increase deficits, and cause inflation to reheat. That could prompt the Fed to delay further rate reductions, keeping financing rates higher for longer. Once again, the Fed rate really does not have that much of an effect on your long-term rates. And that's why I would like to move over to here so we can start digging into this and digging into really what has the largest effect on the rates. That's your 10-year treasury.
Yeah. That's all you got to pay attention to, man. It's the debt market. And it's a little better today. We had talked about this last night. So it's not doom and gloom, but we're at a precipice here. And that's why you see so much panic going on. If the Fed doesn't intervene, because they're the only ones that are going to buy massive amounts of debt. No one else is going to go buying a bunch of bonds and make 3, 4, 5% yield for 10 years. So it has to be them. And if they choose not to intervene, this thing could go off the rails. And we'll kind of explain as we go through this. But right now it's at a precipice. And that's what caused the spike. It was a debt sell-off. Basically people getting out of bonds, and it was weird because even with the stock market going down too, everybody will basically, it looks like they're fleeing to cash. So what they're doing is getting cash positions and just kind of sitting and waiting to see what the heck's going on.
Yeah, that was what was a little out of the norm, because typically what happens is when people start bailing out of the stock market because they're uncomfortable what happens, and that's what happened when the Fed made the rate reduction announcement, is they typically flee to more secure places, such as the 10-year treasury, such as the bond markets. And that did not happen at all. Even the crypto market was affected a little bit as well.
Well, crypto's risk on as well, kind of. But what surprised me was precious metals. They're risk off, and they even dumped. So yeah, it was just a massive panic sell off to everything into cash, and everybody just kind of sitting around. It's recovering a little bit today, so that's kind of positive. But we'll get into it. But yeah.
Yeah, and we can see here, we just took a look at the 5-day comparison of what's happened, and we can see here just from 12/12, going all the way, that was last Thursday, all the way up to right here when the Fed spoke. And it's funny because you could see through the day, oh, look, the Fed spoke, and then immediately it just shot through the roof.
Yeah.
And it shot up quite a bit here. And now we're sitting right at, oops, I got to stop blowing that one up. Yeah, we're sitting at right now 4.496. So we're down 0.04 basis points for the day. Now, people, I want everybody to understand that, yes, this market is in very large fluctuation now. Just because you start seeing this drop, you're not going to see an immediate effect on the interest rates.
Yeah.
And the best way I've always found to describe this to folks is it's kind of like when you're watching the news on what's happening with the price of crude oil. Or the price of crude oil dropped by $20 a barrel today, and you go to your gas station tomorrow morning and your gas prices aren't any different.
Oh.
But if crude oil goes up by $20 a day, they're out there changing those. Well, they electronically change them now. I'm dating myself saying they're out there changing.
Yeah. They don't have to climb up on a ladder like the back when we were kids.
I don't mean to date myself, but you see a much more rapid change for the worse. The same thing happens with the bond market in correlation to the long-term interest rates. So we're going to see, in my opinion, I'm hoping we see over this holiday season a little more leveling, because we've already gone here, and you and I were talking about this earlier, Greg. We had our large shoot up, and then we're really backing down a little bit now at really testing how high this wants to go is what I'm seeing happening.
Yeah. Well, they've obviously intervened today. That's why your stock market's recovering and your interest rates or the yield's going down, the 10-year yield, because the Fed's intervening and they're buying the debt up. So for now, because they could let it go at any time. A lot of people are under the assumption that governments and presidents control this stuff. It's the Federal Reserve banks, man. The truth of everything is follow the money, and that's where it originates from.
Exactly. And that's why I tell to my clients and let them know, if you want to know where we're going as far as the financial side of things, listen to what the Fed tells you. They're going to let you know. Another thing to keep in mind is we also saw over the past couple of years, the Fed has been selling off all those bonds that they bought.
Yeah, they've been lowering their balance sheet. Yeah.
Which there's a possibility, because I brought this as I'm leaving it on the table, I'm not taking this off the table of, hey, wait a minute. If they've been unloading their balance sheet, is one of the reasons they're doing that because they're preparing for having to lower the long-term rates again. So they're selling off what they have, bringing their capital back in. And then if the rates continue to rise, they can just go in the back door and buy back the bonds, which will drive the rates down.
Yeah, it's just a big shell game of moving cash around. That's all it is. Because it goes somewhere. Cash doesn't disappear. It goes from one asset to another.
Well, exactly, but that I'm trying to look at it as a positive perspective and go, hey,
Yeah.
we may hopefully get a little bit of relief, because another thing too, and we were talking about this earlier today, is the if the economy is rocking and rolling and doing well, and the stock market's rolling, and the elites and the big business owners are doing great, that's not good for the interest rates, the long-term interest rates. That's going to have an adverse effect on them. And the only way for those rates to come down, if nobody's buying those bonds, is for the feds to go in and buy the bonds.
Yeah. Yep.
Now, another thing that could happen, I'm going to bring up this other chart, is the Fed could come, or not the Fed, but we could hit a recession.
Yeah. This chart, and I'll kind of explain, this is why everybody's freaking out. Just to explain what this thing is. What you're seeing with the up and down there is that's not the interest rate. What that is, that's a correlation between the federal funds rate and the 10-year treasury. That's how big of a difference it is up or down from being exactly even. All right, so your little gray vertical shaded areas there, those are places where we've actually had recessions. All right, like if you go all the way to the left, that happened. That's the .com burst, basically. That's 2000. Now, when you see the blue line go below the black, that's what they call the inverted yield curve. All right, now when it gets back up to that black line, that's when it's exactly 0 to 0. The Fed funds rate and the Treasury yield are the same. So what we got to be careful of, you'll notice during all the shaded gray areas there, it's a rapid increase, almost parabolic hockey stick type blow off top.
Now this here, though, for everybody to know, this, like Greg was saying, this is the .com boom and bust. Yep. This was the mortgage meltdown of end of 2007, beginning of 2008.
Yep. And then that smaller one to the right there, that's COVID. If I can even say that, C19, I want your video taken down here.
Yeah, we got to be careful. We don't want to run into any trouble on broadcasting.
We'll be talking about that.
We'll call it the pandemic, or whatever you prefer to call it.
So what's happening is, to the far right there, you're going to see, and actually that chart is from 18th. So actually since then, we've hit that black line again when the Fed did their 25-point basis cut. So we're right on the precipice. And what I did when I did a Google search, what's the big deal about federal funds rate and 10-year yield being even? What it said was it's basically a time of uncertainty and nobody knows what's going on, and panic could ensue. More or less what happens. So if this thing continues to go, if the interest rates continue to go up because everybody's selling off and no one's buying those bonds, and it gets rapidly increasing, we're heading into a hell of a recession based on, you'll notice that yield curve, we've been inverted longer than we ever have in history. That one on the far right there on 23 to 24.
Yeah, I was going to mention that. Is like, yeah, look at how long that yield curve inversion is. I mean, that's quite a bit compared to these other ones we had here and these other ones. This one was more of an extended period of time as well, too.
Yeah,
this was back in the time when all you had to do was show it to my office. If you breathed and had a phone number, we had a loan for you, brother.
Exactly. And you'll notice that recession was a little longer than the one in 2001. The recession wasn't as long, but the yield curve wasn't inverted as long either. So now there's nothing that doesn't say that maybe we pop up here and then we go back down because the Fed steps in and makes this thing drags it out a little longer. But that's why everybody's been panicking the last couple of days. So today seems to be some relief. So we'll see. But ultimately, if you want to protect yourself, get out of debt the best you can. If you've been in the stock market since it's went up 200, 300, 400% or something crazy in the last decade or whatever, take some off the table, man. Pay off some debt. It depends what your risk tolerance is. And again, not a financial advisor, just I'm not your dad, but do what's best for your situation because everybody's in a different scenario with that. But it could get ugly, or they could make it go a little longer. We'll see.
And speaking of get out of debt, there's been multiple times that I've sat down with my clients, Greg, and they're like, "But I have this low interest rate right now on my mortgage." And then I look at all their other debt and I go, "Pull up your credit card accounts and tell me what interest rate is on that." And they pull it up and they go,
25 to
"Oh my
30%.
God, 18%, 22%, 29%.
Yeah.
And it's like, okay, if we take that and let's just say, and I'll just use simple math here, and we have $1,300 a month credit card payments or other debt payments, non-secured debt payments, and you have a mortgage rate at 3, but I give you a new mortgage that allows you to pay off all that other debt, and I only raise your monthly payments by $400, you're saving $900 a month to $1,000 a month, and that other debt is gone.
Yep.
That's going to put you in a very strong position to get yourself in a spot where if this economy does go into a recession, you will be a little better off.
Yeah, that's not seeing a forest because of all the trees in front of the situation. I've had conversations with people about that with the because if you wait too long and your credit cards get all maxed out, your utilization is going to be so high, your score is going to dump, and you may not even be able to refinance your way out of it.
Exactly. And that is something, and it goes back to find the mortgage professional you're comfortable with. I hope it's me, John Money McKinley. Find someone that you can sit down with face to face. I have it set up here at my office where I'm able to bring folks into my office without them having to leave their home or leave their work. And they get the same experience as if they're sitting across the table from me and be able to sit down and go over their specific situation. We have it recorded for you. That way you can go back and review everything and make an informed choice. And at the end of the day, if you decide that that's not the best option for you, that's fine. Because I've had many a case where I've sat down with whether it's a first-time home buyer, whether it's someone looking to get out of debt, and we start running the numbers and looking at everything and go, okay, getting this refinance or buying this home is not the right time for you. Here's what you should do. Here's a plan for you. Because the last thing that I want to do is put somebody in a position to where I'm helping them get into a prison, not a home.
Yeah.
That just doesn't do any good. And there's plenty of people out there that will put you into a prison and tell you you're getting into a home.
Yep.
And that's why it's so important to know everything you're looking at when you're going in. Well, we are already coming up to the top of the hour here, Greg. Is there anything else you'd like to dig into on this, or do you think we've given a lot of good information so far today to folks?
No, I think we've covered it. It's what I would probably do, and this is just to help out everybody. First off, ignore anything that talks about inflation going up, down, sticky, or whatever, because they don't even put food and energy in inflation statistics anymore, which is what we're all paying out the nose for. So that's really not having anything to do with it. And it all comes down to that debt market and the 10-year yield. So if the Fed's going to intervene, we're going to be fine. If not, we're going to have a rough couple of years. But on a positive note, if interest rates spike, you might be looking at a deflationary scenario, which prices would go down for a little bit, which means those that have fixed income would actually be better off because they can get more product for their dollars. But that can lead to unemployment because companies don't make as much. So there will be some pain either way, regardless of which way we go. But I would recommend getting out of debt as quick as you can. If you've got anything in the markets or crypto here in the next couple months, it might be a good idea to take some out to pay off some high interest debt. Find a way to make some extra cash with a side hustle, a business of some sort. There's all kinds of little opportunities. You can't rely on just a job anymore, hardly. So it's all going to come down to mentality and mind. If things start going bad and you're woe is me, then you're going to have a woe is me year. If you think outside the box and do something instead of reacting, things will turn out pretty well for you. Because regardless of the economic situations, if you're in a good position, in a good frame of mind, you'll do well.
Well, I appreciate it, Greg, and I appreciate you coming on here right before the holidays, and like to wish everybody a Merry Christmas, Happy Festivus, or whatever you celebrate for here.
Krampus.
Yeah, this time of year. And of course, Greg, a Merry Christmas to you and your family as well.
You too, bud.
Full disclosure here to everybody. I've known Greg and been working with Greg for over 25 years now, and he is my go-to credit expert when people have credit challenges. And I would strongly recommend, if you want a free consultation, that you reach out to Mr. West and talk to him. He'll show you how to get your credit reports, to be able to get him over a copy that won't cost you $1 to get him the credit reports, and send it over to him, and he'll do a free consultation. And if they would like to do that, Greg, what's the best way they can reach you?
A couple places. You can call me directly, 859-625-4546. Or I've got a website. You can go to westcreditservices.com, WEST creditservices.com. Fill out a little form. I'll call you anytime and help you out the best I can, or send you to somebody who can, if depending on your situation.
Yeah. Well, thank you very much, Greg. I'm going to put you back in the green room, and I'd like to say goodbye to everybody. And once again, you all have a very Merry Christmas. And please do me a favor, like, share, subscribe. Really want to try to get this show out to as many people as possible. And if you know anybody who would like to be a guest on the show, who you think is a great credit expert, please reach out to me. My text number is right up there. Just shoot me a text with their name and number. I would love to go ahead and chat with them and possibly have them on the show. Once again, y'all have a Merry Christmas.
You better watch out, you better not cry, you better not pout. I'm telling you why, Santa Claus is coming to town.